Welcome to DeFiChain Demystified, where we dive deeper in special topics around our project. The goal is to bring answers to some tricky questions and maybe bust some myths. We are
Kügi,
and Lord Mark, and today's topic is
what affects the APR of the dToken pools?
interesting question. Kügi, welcome back.
Thanks for having me.
Cool. Hey, we picked another topic where we have a couple of heard that there are a couple of misunderstandings maybe, or maybe we can shed some light and see if we can bust one or the other myth. I would say we just jump right into your fantastic animations and then you take it away.
Woohoo! Thanks. Yes. Again, as always, ask a simple question. I start with a long explanation. So let's do that again because that's always fun. When you talk about APRs in liquidity mining, we want to talk about the dTokens, but I thought it's better to start with
From the beginning where we
crypto
come
pools.
from in some way. Yeah, okay, good idea.
In some way from the beginning, and it's also a bit easier if you have less moving parts, say it this way.
Absolutely.
So let's go a bit into the details or a bit into the things that we have there. So if we have a dToken pool, if we have a liquidity mining pool, you always have two assets in there, and we now say we are in a crypto pool where we have DFI and BTC. First thing that most of the people know is that within this pool, we always have a 50-50 ratio between those assets. And this 50-50 ratio is in two ways, basically, because we can now say we always have a 50-50 ratio in this pool, but on the other hand, the pool ratio defines what 50-50 means. Because as we had that with swapping and everything in another video, it's when you have in there 10,000 DFI and 1 Bitcoin, the pool defines that now 10,000 DFI is worth 1 Bitcoin. So you have a 50-50. If you swap and suddenly you have 5,000 DFI in there and 2 Bitcoin, the pool says 5,000 DFI are worth 2 Bitcoin. So it's because it's in those two assets are in a pool, that means it's a 50-50 value. And you as a liquidity provider always hold a share of this whole pool. So you have a few tokens, and that means you get or you have the right to a part of this 50-50 share. So that's just important to have. This is always a 50-50 share. Now to the rewards, what comes out, because there's always a bit of what is a reward, what is a commission. Basically, there are two types of things that come out of the pool for you as a liquidity provider. On the one hand, we have the rewards, which is basically your share of the block rewards, because each block on a DeFi chain, liquidity providers get paid DFI for providing liquidity. These rewards are always DFI because that's what the chain can pay to users. We can't create other stuff generally, but we create DFI. So those rewards are always in DFI. The other side is that you get commission. So if people swap, if people trade on that pool, they pay 0.1% usually a fee for trading on the pool. And those commissions, that's the trading fees summed up over all the swaps that happened in that block, is again shared over all liquidity providers. So if you provide 1% of the liquidity of this pool, you get 1% of all the trading fees that accumulate on this pool. And because we have those two assets, means we get a commission in those two assets. So if people swap from BTC to DFI, they pay commission, they pay fee in BTC. If they swap from DFI to BTC, they pay commission in DFI. So you get BTC and DFI. Now, this ratio of APR, where we say, okay, how much APR do you get, is what's my return on investment, basically, on my size of the, or on my share of the pool. It's the DFI of the rewards plus the commission. And on DeFiScan and different platforms, we now see since a few weeks, I think, this separation between that's your rewards and that's your expected commission. the rewards are known. We know how much DFI per pool per block is distributed. The commission is like, currently we have this trading volume. If we have now a high trading volume, we expect that commission. But it could be that from 1 minute to the other, no one is trading that pool anymore, and the commission goes down. So the reward APR is kind of calculatable. The commission is more like an estimation.
Okay.
And now, how do you want to ask something? No, just
No, I wanted to add, it seems that there are days with high volume. So you can check in your history. For example, if you use DFI.tax, fantastic tool that splits it up between rewards and commission, and you see for the past day, if there's a high volatility, if there's a lot of volatility, big sell-off, or the price pumps, people trade more, the commissions really spike. Or also if new pools get added to a system, a lot of people start swapping, you see a dramatic increase in commission. Makes a big difference day by day, right?
exactly. And that's also that sometimes you need to be careful what pool to choose, because if you have a really high volatile day, it could be that the commission is the same size as the rewards, and suddenly it looks like this pool gives you twice the APR than the other pools.
Very good point, yeah.
2 days, and you jump into that pool because you see just the total APR, and 2 days later this pool is down again, and you're like, what's happening? But that's because the commission is now gone. That's happening on the dTokens. Back to the dTokens, sometimes when you have one stock pumping, if MicroStrategy is pumping, Facebook pumping, whatever, or dumping, whatever, a lot of volume is traded on that, and suddenly the commission goes up like crazy on that pool, on that swap. And 1 day later, it's back to normal. So be careful on where the reward actually comes.
Excellent point, yeah.
And now to our original topic. When I now say I increase the value of this, so I still have the 50-50 because it's balancing out all the time, but now DFI and BTC rise in value, and the value of the whole pool gets bigger. My share of the pool is the same, so it's not that people add liquidity, but it's because it's just the value changes of the whole thing. That means my rewards are still the same DFI, but DFI is more valuable now. That's why they raise. Also, I get the same amount of DFI and BTC, but the value of them rises. So in dollars, measured in dollars, I get more rewards, more commission, but also my dollar value of my share of the pool rose. So the APR, my rewards relative to the whole thing, is basically stable because it's the same thing. If my share of the pool is reduced, I get less of the rewards, and therefore the APR in total goes down. So that's in this case where the value of the tokens or assets that I have in there also affects, because it's the same token, it also affects the rewards that I get, and therefore the APR, which is a ratio between those basically, is not that much affected. Different topic if we go to the dTokens. Because in the dTokens, we have the same idea. We have a pool, we have liquidity mining, we have rewards. But now you see we have a DUSD in the pool, we have the dToken in the pool, but we have rewards still in DeFi. We have the commission in DUSD and dToken, because that's from the swap, that's the asset what we had. But the rewards are in DeFi. So now, if this dToken pumps like crazy, the whole pool goes up, but the DFI value is unaffected because DFI didn't change because of that. If that goes down again, just that you don't have it too big, it's not affected. If the DFI price on the other side pumps, the dollar value of the dToken DUSD in the pool stay the same if no liquidity is added or changed. If it just stay in there and doesn't, no one touches anything, the DFI value of those DFI that I get is still increases, but this USD value stays the same. So my relative APR, because the APR is always relative to your invested value, I still have, say, $1,000 dollar worth of USD and dToken in the pool, I got, I don't know, $1 worth of DFI. So 1 DFI per day, I don't know, what would be a nice, never mind. Let's say one DFI.
Yeah, 1 DFI per day.
I get 1 DFI per day for the $1,000 in here. Would be $1 now. So $1 per day, $300 is 36% APR. It's realistic APR that we have right now. If now DFI pumps to $4, I still get the 1 DFI per day in rewards, but suddenly this 1 DFI is worth $4. So over the year, I get $1,200 in rewards on a $1,000 liquidity share. So suddenly my APR is 120%, although nothing happened here. And that's why this APR moves based on the DFI price. And that's also why when the drop happened, the APR went from 100% on APR on the pools. I think it was around 100% before the drop, and now it's 30% because DFI dropped roughly 75% from $4 to $1. So that's basically the ratio that we had. That's why the APR dropped, because you still get the same DFI.
Okay.
The same, similar amount of DFI.
Question, Kügi. You mentioned, if you can jump back to the previous slide, please, where we had the BTC. So this is liquidity mining. I think a lot of people might ask now, how does this affect the APR on staking? Is staking then more profitable in those times? What's the question here?
The thing is, in staking, you basically have the same idea as you have here. You don't have commission, but you have the same idea as you have it here, just without the BTC. So you have your share of the staking, of the overall staking pool. You can view it as a liquidity pool without a second asset, just DFI. You have a share of this whole liquidity or staking pool, and per block there is, in this case, it's not that it's every block it's shared across all, but over time it's shared across all staking nodes. So you still get, for your DFI invested, you get amount of DFI in rewards. That's why it's the same idea, stable. It's even more stable because if BTC compared to DFI moves here, the whole thing moves a bit. With staking, it's like you get your APR in DFI. In dollar, it might go up or down, but in DFI, it's super stable as long as not much happening with master nodes created or not.
Okay. And no commission, like you mentioned. Okay.
Exactly. No commission and no effects of impermanent loss, liquidity shifts and stuff.
So the APR, in some way, you always have to be careful on what the yield or the interest that you earn is based on, right? One time it's crypto, the other side it's kind of US dollar value, and then the price of the reward, the asset that you get as reward, impacts the APR dramatically. Okay.
Exactly. And one more thing to that, to just have this also mentioned, because it fits the whole idea. We have this in the whole, that's in the code basically. We have block rewards. For each block, there are currently 56.62 DFI per block emitted, created, and shared over the dToken pools. That's the dToken pool rewards. They are every block 56.62. They reduce over time. Currently it's 56.62, but they only reduce algorithmically. It has nothing to do with prices of the market or anything. Always that amount per block. And then they are shared via these ratios that you always have in a news show when you have the dTokens, where we say, okay, that's now how the pool rewards are shared, where we say 50% of those, so 28 something, go to the USD DFI pool, 6% to the SPY pool, and so on until 0.2% to the pool. So that's a basically fixed amount of DFI that goes into the pool and is then split up over all the liquidity providers of this pool. And that's the DFI that come out here as the reward. That's why this is fixed, because this is fixed. And as long as the whole liquidity in the pool stays the same, this also stays the same for you. It's just a value that the USD value of that might move up or down.
Kügi, now I hear many times that people say, please ticker council, don't bring so many new ticker to the chain. Don't do the 4 a month, because this would drive the APR in the dToken system further down. And we don't want this, because we want higher APR. Is that true, or is there a problem with that thought process?
There is a big problem. So if you ask like that, of course there's a problem.
Yeah, I don't know.
No, the thing is, yes, in the first approach, when you say we have now more pools, that means we need to split this 56 DFI over more pools. Means each pool gets less DFI. I mean, the DUSD DFI stays at 50, but the others, SPY, will get less than 6% of that after that. So I understand where the idea comes from, where this, I get now, it's no longer 6%, it's now 5% or something. But the thing is, we have a liquidity in the whole system, in the whole dToken system. If you think about it as the whole dToken pools, all those pools together have a liquidity of few hundred million liquidity. So 56.62 DFI are distributed over those, let's say, I have the number, but over those $300 million in liquidity. If now another pool comes in, this liquidity will shift, because it's not that everyone stays in their pool and we have a new pool with a lot of liquidity, a lot of APR, because there's no liquidity in there, and this pool is filled only from outside, from new people coming in and sending additional liquidity to this pool. But the liquidity that's already in the system, those 300 million, will restructure so that it's basically evens out, because you see that the APRs have a similar curve all the time. So you have the pools that are more interesting, that the gold and stuff, where you say, okay, a lot of people want into this pool, therefore the APR is low there, and then the others all are in a 20 to 30% range right now. So if a new pool comes in, those 300 millions gets reshuffled, people move around, but still the 56 DFI get distributed over the 300 million. So if you have $1,000 in this, your part is 1,000 of this 300 million, your part of the reward, your part of the 56 DFI is still 1 over 3,000, so 1,000 of 3 million is still the same ratio of that after the whole thing moves. Maybe you want to move, if you just hunt the biggest reward, you want to move, but overall it evens out. It's just, in my opinion, it's the other way around, because more pools means there might be pools that people want to get in from outside, that are not, that weren't in before. Because right now, everybody who wants to get into the existing pools is already in, probably. New pools mean more interest in the system, more money flowing into the system, means more interest on DFI, means DFI goes up, means your rewards get value more, because if this value goes up, you get more APR. So it's actually good for the system if you have more pools, more tickers, to get more interest, more demand, everything goes crazy.
Okay, good. Myth busted in that case. It means more ticker is out. I mean, might have different impacts, but at least for the APR, it has no direct impact, because the liquidity is distributed over all pools, and as long as not more liquidity flows in, if I understand it correct, at the end nobody loses out. Correct. Cool, Kügi. Thanks for busting some myths. Thanks for explaining that. I think this was very, very easy to follow, especially where do we come from, where do we go. Yeah, thanks a lot for explaining that. And guys, I hope that shed some more light on how our APR is calculated, what's the difference, and how that does all play together. Thanks for watching. Kügi, thanks for explaining, and I hope to see you soon in the next episode of DeFiChain Demystified. Have a nice evening, and bye-bye.
Have a nice evening.